and the earnings of the business. Here's transaction numbers on the left-hand side. So let's start. Here's transaction number 1. So you can turn to page 117 in your notebook. You're going to do this. I promise you, if you think you're going to learn what I'm about to teach by sitting there and watching, you're wrong. You're wrong. If you want to learn what I'm about to teach, go ahead and do the exercise with me. Don't try to be cool and sit there. Go ahead and do the work. Here's transaction number 1. This is the words on page 117. It says, we invest $5,000 in cash to create the Mighty Fine Lemonade Company. The company receives a $5,000 investment. Okay, the company receives a $5,000 investment. The company also receives $5,000 of cash. And so we're going to turn to the Rosetta Stone on transaction number 1. Here's transaction number 1 right here. Here's the line right here. That's the line right here at the top. Transaction number 1. Listen to my words. The company receives $5,000 of cash. Do you see a column on the Rosetta Stone called cash? Hello? Yes. Then in the column called cash on line number 1, we got to put a number in there. What number do you think we ought to put in that box? 5,000. Now let me ask you a question. As a result of this transaction, did the amount of cash in the business go up, or did the amount of cash in the business go down? What do you think? It went up. If the number gets larger, it's a positive number. If the number gets lower, it's a negative number. It's easy, right? We don't have to use the D word and the C word, right? We don't have to do that. Debits and credits. We just say, wait a minute, did the number get bigger or the number get smaller? How hard can this be? Well, good. So I got 5,000. Now, take a look at this. Here's the equal sign. This is a balance sheet, so it has to balance. The left-hand side has to equal the right-hand side. Right now, the left-hand side just went up by 5,000, and there's nothing on the right-hand side. So I asked the question, where did that money come from? Did the money come from accounts receivable? Hello? No. Did the money come from inventory? No. Did the money come because I sold some of my shit, some of my property, plant, and equipment? No. Did the money come because I borrowed some money? No, I didn't borrow any money. Did the money come as a result of an investment? Yes. Do you see a column entitled investment? Good. In the column entitled investment on line number 1, right here in this box, you got to write down a number. What number do you think you got to write down? Oh, you guys are naturals. This is unbelievable. I think there may be 2,200 budding accountants in this room. Okay, I know. All right, so this is what accountants do all day long. Accountants take words and convert it into numbers. So good, we're going to do that for a minute and see if we can get some optics. Here we go, transaction number 2. Holy cow, that's a lot of words. We borrow $8,000 cash from the bank. The note payable is due over 2 years. The interest rate is 10%. Interest expense payments are made at the end of each year. Year 1 loan repayment is $4,000 of cash, and year 1 interest expense is payment of $800 cash. All right, there's 3 moving parts to this one. We're going to borrow some money, we're going to pay some interest, and we're going to repay part of the note. Okay, so let's record in line number 2. This is transaction number 2. Let's record in line number 2, borrowing the money. Only borrow the money in line number 2. Now, I don't know about you, but when I go to the bank to borrow money, they generally deposit some cash in my bank account. So I'm pretty sure that cash is one of the entries that I'm going to make. So my cash in line number 2, in that box right there, in line number 2, I think my cash just went up by 8,000. Good, I'm going to write that number down, 8,000. Now, where did that cash come from? I borrowed it. If I borrowed it, I owe somebody some money. So I'm going to go to the O section. Is it an account payable, taxes payable, or notes payable? Notes payable, you're exactly right. So in the notes payable column on line number 2, I'm going to write a number right in that box right there. What number am I going to write down? 8,000. But since I owe it, it's a negative number, right? Hello? I owe the money, so it's a negative number. Is that right? I owe the money. Oh, whoa. Let me ask you a question. Is the amount that I owe just went up or did it go down? The amount that I owe went up, therefore it's a positive number. Forget about I owe it, so it's a negative number. That makes no sense. I'm just going to ask the question, is the amount that I owe bigger or smaller? It just got bigger, so in the notes payable column on line number 2, in that box right there, I'm going to write down that my notes payable just went up by 8,000. It's a positive number. I got to pay some interest. How much was the interest I'm going to pay? 800. Is that right? I got to pay 800 of interest. You'll see a line right here on the Rosetta Stone called interest. And over on the right-hand side, it says interest expense. So right here, there's a line called interest. I'm going to use, check this out. I'm going to use 800 of my cash. I'm going to use 800 of my cash. So I don't know about you, but when I pay interest, my cash goes down. I'm going to use 800 of my cash, and interest is an expense, and expenses reduce earnings. Interest is an expense, and expenses reduce earnings. Do you see a column on this page called earnings? Yeah. Good. I want you to record on the interest line that you used 800 of your cash, and your earnings just went down by 800 because interest is an expense and expenses reduce earnings. So go ahead and record this transaction. Check your neighbor. Make sure they're cool on the interest line. Make sure they're cool. Literally, look at their piece of paper. This is called cheating. Coaching is a high form of cheating, right? Tell them if they got a different answer than you, talk through it. Let them know what's going on. Why did you get a different answer? Here's the answer I got, by the way. Watch right here. Here's the answer I got. I think my cash just went down by 800 and my earnings just went down by 800. I think that's what happened. There's one more part to this transaction. One more part to this transaction. And that is, we're going to repay 4,000 of the loan. Repay 4,000 of the loan. So you'll notice right here, about 3 lines up from the bottom, there's something called NR. That stands for note repayment. NR, note repayment. So I'm going to repay 4,000 of this $8,000 loan. Now, I don't know about you, but every time I repay debt, my cash goes down. So let's record that. On the NR line, under the column of cash, I'm going to record that I used 4,000 of my cash. I used 4,000 of my cash. It just went down by 4,000. Where did that cash go? Where did it go? It paid off the note. I have a note payable column right here, a note payable column right here. I'm looking at the right slide right now so you guys can see my pointer. I'm looking at the note payable column. In this column, I repaid 4,000 of the notes. So the amount that I owe in note payable just went down by 4,000. You see what's happening? We're just making sure the balance sheet stays in balance and we're converting words into numbers, which is what accountants do all day long, which helps explain their personalities all day long. Every day they're doing this. Here comes transaction number 3. We purchased a computer, printer, and software for the business. Total price was $4,500. We paid cash. The estimated useful life is 3 years. Therefore, depreciation expense is $1,500. I'm not going to spend time talking about depreciation. All I want you to know is this machinery, this equipment that we bought cost a total of $4,500. It's going to last 3 years, and so the depreciation is $1,500 a year. So here we go. This is a two-part transaction. I'm going to record the first part on a separate line. So we're going to take $4,500 of our cash, and we're going to buy $4,500 worth of property, plant, and equipment. So turn to the Rosetta Stone. And on line number 3 on the Rosetta Stone, we're going to take $4,500 of our cash and buy $4,500 worth of property, plant, and equipment. You record this transaction. You record this transaction. If you don't know what to do, ask your neighbor. Check your neighbor. Make sure they're coming up with the same answer you are. If they're not, talk it over. We're using $4,500 of our cash to buy $4,500 of property, plant, and equipment. Looks to me like what we're doing is we're trading one asset for another asset. Is that what you're thinking? Hello? Yeah, we're just taking some of our cash and we're using our cash to acquire another asset. So if I look at the Rosetta Stone, look at the right slide up here in the front. Look at the right slide. On line number 3, I'm going to use $4,500 of my cash to buy $4,500 of property, plant, and equipment. So the left-hand side went up by $4,500. It went down by $4,500, so I stayed in balance. Hello? Yes. This is not that hard. Okay, depreciation. You'll know, look at the right-hand slide in the front. Right-hand slide is where I'm going to operate so that everybody can see. Here's a line right here called depreciation. You see that line right there? Hello? This line right here called depreciation. I'm going to depreciate, listen to me, I'm going to depreciate the property, plant, and equipment by $1,500. And depreciation is an expense, and expenses reduce earnings. Record this transaction. Record the transaction of depreciating property, plant, and equipment by $1,500. Find the property, plant, and equipment column. On the depreciation line, property, plant, and equipment, watch, here it comes. Property, plant, and equipment is going to go down by $1,500. That's an expense, and expenses reduce earnings. Find the earnings column, and on the depreciation line, reduce earnings by $1,500. An expense reduces earnings every single time. Watch up here. Watch up here. There it is. There it is. My property, plant, and equipment went down. Earnings went down. I stayed in balance. $1,500. Here we go. Transaction number 4. 4.1. We purchase enough inventory to actually make 75,000 liters. Inventory raw materials cost 20 cents per liter, so we paid $15,000 of cash. So let me tell you what just happened. We used $15,000 of our cash to buy $15,000 worth of inventory. Looks to me like what I did is I traded one asset for another asset. I used $1,500 of cash to buy $15,000 of cash to buy $15,000 of inventory. So if I turn to the Rosetta Stone, and on line 4.1, I'm on this right-hand slide at the very front, right up here. On this line, I want you to record that we used $15,000 of cash to buy 15,000 of inventory. We trade one asset for another asset. Go ahead. Go ahead and do it. Check your neighbor, make sure they're cool. Are we there? Did you guys get there? Yes, ma'am. Wait. Can we get a mic right over here? Yep, good. Oh, no. Yeah, all the way over there. All the way over there. No, it's right here. Here's where I'm going, right here. Okay. Wait. Hang on. Tell me your name.
Hi, I'm Victoria.
Victoria. I'm Keith.
Very nice to meet you.
Very nice to know you. How can I help?
Question. What threw me off, the depreciation. It says that it's over the 3 years. So
yes.
What made sense that it would be $500, it would be $1,500 divided by 3 over the course of 3 years.
All right, so good point. Victoria, watch this. We bought $4,500 worth of crap. It's not going to last forever. It's going to last 3 years. And the government says, not reality, the government says, this crap that you bought is going to go down in value by $1,500 a year. So we get to the end of 3 years, and it's theoretically worth nothing.
Right.
Right? So it's $1,500 a year. If the government would have said, okay, this crap that you bought is going to last 10 years, then we would have spent $4,500, and every year we'd have depreciation of $450. $450 every year, $450. And at the end of 10 years, the book value of this crap is zero. Right now, the book value of this crap, you spent $4,500 for it, and it's now at the end of the first year, theoretically, book value only worth $3,000. And at the end of the next year, we're going to depreciate another $1,500, and at the end of the next year, we're going to depreciate another $1,500, and so it's going to be zero, even though you're still using it.
So the $1,500 was the annual amount.
That's the annual amount. That's it. That's the annual amount. Okay, great job. Are you good, Victoria? All right, good. Thank you. I got one more question right here. Here we go. So wait. So just so everybody's clear, here's where we are. We're on transaction 4.1. We purchased 15,000 of inventory. We used 15,000 of our cash. So I'm right here. I'm going to use 15,000 of our cash. Cash goes down. Inventory goes up by 1,500. Yes, sir.
Hello?
Yeah, hello.
Hi.
Hello.
My name is Bijan. We don't have $15,000 of cash.
Give him a hand, ladies and gentlemen. Really, seriously. Nice job.
I don't see any other sources of credit.
I got it. All right, so here we go. What's your name?
Bijan.
Vjan?
Yes.
Vjan.
With a B.
We don't have that name in Texas.
No, you don't.
Vjan? Am I doing that better? Vjan. Bijan. Oh, I thought it was V. Here, you don't know this, but it's true. This is on me, not you. I am almost deaf. And it's really sad. I wear hearing aids. I can't hear out of my left ear. My right ear is all fucked up. And so I have to read lips, and a lot of times. And so when somebody starts talking to me and I can't see their face, or they have a little bit of an accent, it makes it really hard. Plus I have Texas ears, so that's a problem. So anyway, my apologies. All right, check this out, Bijan. Check this out. Do you remember, does this look like, everything we're doing up here, does this look like a balance sheet, an income statement, or a statement of cash flow? What do you think? It looks like a balance sheet, doesn't it? And a balance sheet, is it a snapshot or a movie? I forgot.
It's a snapshot.
It's a snapshot. It's a moment in time at the end of the year. So no place on here does it say that we went out and in one lump sum spent $15,000. If we're in the lemonade business, I'm pretty sure we didn't buy $15,000 worth of lemons all at the same time. Instead, we bought a little bit this month, a little bit the month later, and over the course of the year, we spent $15,000 in inventory. Are you with me?
Yeah.
So it's a great catch. It's a great catch. And it gives me an opportunity to teach another part of this, which is, keep in mind, this is a snapshot. This is the way it looks at the end of the year.
End of the year.
End of the year. This is the way it looks. During the year, we spent, so here's what we did during the year. Here's what we did during the year. During the year, inventory raw materials. This is the amount we purchased throughout the year, so that we get to the end of the year and say, hey, when I add up all the money that got spent, the way it's going to look is I used a total of $15,000 of cash to buy a total of $15,000 of inventory. I just didn't do it all at one time. Are you with me?
Yeah.
Good. Give him a hand. Nice job. Thank you. Okay, here we go. Line 4.2. We sold 50,000 liters at $1 each. Of the 50,000 in sales, 31,000 was in cash, 19,000 were accounts receivable. Listen, before you start, listen. Sales are good for earnings. Sales are good for earnings. I had 50,000 of sales, of which 31,000 was in cash and 19,000 was in accounts receivable. Record this transaction on the Rosetta Stone on line 4.2. On line 4.2, cash went up by 31. Accounts receivable went up by 19. Earnings went up by 50. Everything else on the balance sheet stayed exactly the same except for those three columns. Check your neighbor, make sure they're cool. Seriously, just look at their piece of paper. Make sure they got the same answer you did.
So, you're good?
Okay,
We're
here's
either
the way
both
it
right
looks.
or we're both
Here's
wrong.
the way it looks, right up here on the right-hand screen. On line 4.2, cash just went up by 31. AR just went up by 19. Sales, earnings just went up by 50. Y'all are doing great. Here we go. Transaction 4.3. Yes, sir. Hang on. They're going to bring in a microphone. Give him a hand, ladies and gentlemen. Okay, what's your name?
Thank you, Keith. My name is Cameron Murphy.
Cameron?
Yes.
Nice to know you.
Before we get too far ahead, when it comes to depreciation,
Depreciation.
let's say your fiscal year follows the calendar year, and you're
Doesn't
gonna-
matter.
And just
Doesn't
hypothetical.
matter.
Just
That's
hypothetical.
it doesn't matter. Don't look. I'm going to tell you this, and it's a great question. I appreciate the question. But if you and I do a deep dive into depreciation, you're not going to leave here richer.
Okay.
I want you to be rich. Accountants understand depreciation. It's why they're not rich. They're experts in depreciation.
Fair enough.
Good. So if your calendar year, fiscal year, it doesn't matter.
But that's not the question, though.
Okay.
The question is, if you're going to depreciate it $1,500 in a year, and you buy it in November, when does that?
Don't worry about it. That's why you have accountants.
Thank you.
Yeah, you're very welcome. When we sold 50,000 of sales, listen, when we sold 50,000 in revenue, 50,000 of lemonade, we used some of our inventory. So we used to have $15,000 worth of inventory, but when we sold the lemonade, we consumed some of that inventory, and it turns out that in order to produce 50,000 of revenue, we used $10,000 of our inventory as a cost of goods sold. That's what cost of goods sold is. Cost of goods sold is when you consume some of the inventory that you previously have bought. So we got to record that transaction that we used 10,000 of our inventory. The inventory we used was an expense, and expenses reduce earnings. We used 10,000 of our inventory as a cost of goods sold. Cost of goods sold is an expense, and expenses reduce earnings. So there's two parts to this transaction. Inventory just went down by 10,000. Earnings just went down by 10,000. It looks to me like on line 4.3, I look and see, well, I used 10,000 worth of my inventory, so my inventory went down by 10, and my earnings also went down by 10. And now I'm in balance. Hello? Okay, here we go. Here we go. Transaction 5. Expenses for rent, office supplies, payroll, advertising total $18,500 for the year. We used $16,500 to cash, and the rest, $2,000, is an account payable. All right, now check this out. We had $18,500 of total expenses, of which expenses reduce earnings. Expenses reduce earnings. So our earnings got whacked by $18,500. Well, how did we pay for it? The way we paid for it is we used $16,500 of our cash, and we gave somebody an IOU. An IOU. In other words, we used somebody's services, but we didn't pay them, so now we have an account payable. We owe somebody $2,000, and the amount we owe just went up, or did it go down? The amount we owe just went up, so therefore it's going to be a positive number. All right, here we go. On line 5, right here on line 5, we used $16,500 to cash. We gave somebody a $2,000 IOU, and the total expenses that were incurred, not paid for, the total expenses incurred that reduced earnings was a total of $18,500. Transaction number 6, estimated income tax expense came to $2,000. We paid $1,500 of that in cash, and the rest, $500, is taxes payable. 3 parts to this transaction. You use $1,500 of your cash, you give the government an IOU for $500, so the amount you owe just went up. Used $1,500 of cash, gave the government a $500 IOU, and your total expenses for taxes, which reduce earnings, your total expenses were $2,000. Record this transaction number 6 right here where it says taxes. Right here at the very bottom, the last about 5 lines up from the bottom where it says taxes, record the transaction of using $1,500 of your cash, give the government a $500 IOU, and your total expenses are $2,000. Check your neighbor. Make sure they're cool. Make sure they're cool. Okay, here's what I came up with. Taxes. I used $1,500 of cash, so I used some cash. My taxes payable went up by $500, and the total amount of earnings that expenses that reduced earnings was a total of $2,000. Is that what you got? Yeah. Hello? All right, now look what you just did. Turn back to page 117. I think that's the page. What's the page with all the transactions? What's that? 117. Turn to page 117. What you just did is converted all those words into numbers. You did it. I didn't give you a single answer. I didn't give you one. I just said, okay, and I just started asking questions, and you knew exactly what to do. You took all those words and converted it into numbers, and we recorded these numbers on the Rosetta Stone. Now watch this. Watch up here. Watch up here. If you add up all these columns, what you're going to see across the bottom of this page is a balance sheet. Do you see that? See all those red numbers? Hello? Yes. See all those red numbers? Turn back to page 114 in your book. Turn back to page 114. Is that 114? Yeah. Every one of those numbers are on page 114. They're exactly the same numbers that you're looking at the bottom of the Rosetta Stone. Every one of them are exactly the same. So what we've done is on a Rosetta Stone is we've created a balance sheet. And if I wanted to look at the balance sheet and say, well, how did I get to $1,700 of cash? I can see all these transactions that caused it to happen. Alternatively, I could say, well, if I want to know how I got to $17,200 of earnings, I could look at all these transactions in the earnings column and see that's how I did it. So on one piece of paper, I've got a balance sheet. Looks exactly the same as page 114. All the numbers are the same. Take a look at the far right-hand column. In the far right-hand column of the Rosetta Stone, I've got a statement of earnings. I've got a profit and loss. I've got an income statement. So I've got an income statement on the right-hand side. And you can see that there's a transaction that got me $50,000 of revenue, and cost of goods sold was $10,000, and operating expenses $18,500, interest $800, depreciation $1,500, taxes $2,000. If I add all those expenses up and subtract it from the revenue, I'm left over with $17,200 of profit. So on one piece of paper across the bottom, I got a balance sheet. On the right-hand side, I have an income statement. And this income statement that you're looking at on the Rosetta Stone is exactly the same income statement that's on page 115 in your notebook. It's exactly the same. So on one piece of paper, I've got two of the three dials. Take a look at that left-hand column. And that left-hand column is all of the cash transactions that happened during the course of the year. I can say, well, yeah, my cash went up by $5,000, then it went up by $8,000, then it went down by $4,500, then it went down by $15,000. And every one of these transactions that you're seeing in the Rosetta Stone are exactly the same as the transactions on a statement of cash flow. The only difference, here it comes, the only difference is the statement of cash flow and the Rosetta Stone are in a little bit different order. They're a little bit different orders. So if we go back to the Rosetta Stone at the very top, $5,000, that came from an investment. $8,000, we borrowed that from the bank. $4,500 is money we spent on property, plant, and equipment. Well, that's not what's at the top up here. Instead, those transactions that we just talked about are right here. We got $5,000 from the investors, $8,000 from the bank. We used $4,500 to buy some assets. So the statement of cash flow that you're going to get from an accountant is in a different order, but all the numbers are exactly the same on both pieces of paper. And what we have on a statement of cash flow is we have O's, I's, and F's, the cash flow of the business. The cash flow of the business is $1,700. Well, if I started with 0 and I end with $1,700, the cash flow has got to be $1,700. And the way I got to that is a certain amount was O cash, and another part was I cash, and another part was F cash. And if I add together O, I, and F, those three added together add to plus $1,700. If I start with 0 and have cash flow of $1,700, I'm going to end with $1,700. Hello? Statement of cash flow on the left-hand side. So here we go. Watch this. Check this out. On one piece of paper, I have a balance sheet across the bottom. I have an income statement on the right-hand side, and I got a statement of cash flow on the left-hand side. On one piece of paper. Not three. On one. Now let me tell you why this is cool. This is cool when you see it like this instead of the way the accountants do it. This is cool because without remembering what happened, I can look at this piece of paper, look at the numbers, and describe what happened. Watch this. On line number 1, right here, cash went up by 5,000. I'm not remembering, I'm just looking at the numbers. Cash went up by 5,000. Where'd that cash come from? The investment. Investment went up by 5,000. Looks to me like what happened is that somebody invested 5,000 of cash into this business. Look at line number 2. Line number 2, cash went up by 8,000, notes payable went up by 8,000. Looks to me like what happened is we went to the bank and borrowed $8,000 and deposited that money into our account. Look at line number 3. Used 4,500 of our cash. Cash went down. Where'd it go? Oh, we bought some property, plant, and equipment because it went up by 4,500. So it looks to me like what happened is we used 4,500 of our cash to go buy 4,500 of property, plant, and equipment. Look at line 4.1. I took 15,000 of our cash. Cash went down by 15,000. Where did it go? I bought 15,000 worth of inventory. Oh, looks to me like what happened is we used 15,000 of our cash during the course of the year to buy 15,000 worth of inventory. Do you see what I'm doing right now? I'm looking at numbers, converting them back into words. Accountants take words and convert it into numbers. Business optics, business intelligence, business mastery. Business mastery is when you can take the numbers and convert them back into activities so you can change the activities that's causing the shitty results and therefore wind up with better results. There's only one thing that's missing on this piece of paper, and that is whether it's O, I, or F. Whether it's O cash, I cash, or F cash. And so I'm going to give it to you. And you're going to make a note in your notebook. The very first line where we raised money from investors is F cash. The second line where we raised money from banks is F cash. That's financing cash. When we bought some inventory, when we bought property, plant, and equipment, that's I cash. That's investing cash. We use some of our money to buy some property, plant, and equipment. That's the definition of investing cash. Look at line 4.1. Line 4.1, we bought looks like we used cash to buy inventory. That's O cash. We used O cash when we bought inventory. The next line is cash. That all happened as a result of some sales we made. We made 50,000 in sales. We collected 31,000 in cash. That's O cash. Line 4.3, there's no cash. So I'm not going to talk about it. There's no cash transaction when we sell inventory. We sold inventory, which we'd already paid for. We had an expense, we had an expense, we had a cost, we consumed inventory, but it did not touch cash. This all happened because we had already bought all this inventory and now we just used 10,000 of it. The next line, which is expenses, that's O cash. Interest is O cash. Interest is rent. Interest is rent on the money. Rent is operating cash. It consumes operating cash. Depreciation, there's not highlighted yellow. Depreciation has nothing to do with cash. It's an expense, but it's not cash. Taxes, O cash. Note repayment, financing cash. Note repayment, financing cash. Taxes, operating cash. So now that I've got the O's, I's, and F's all on one piece of paper, along with statement of cash flow, income statement, and balance sheet, I actually have optics. Watch this. Watch this. I want you to look at line 4.2, right here on line 4.2, and here's what it says. Cash went up by 31,000. AR went up by 19,000. earnings or revenue went up by 50. Those are the three numbers. I want you to look at those three numbers, not remember, don't try to remember, don't read it off your notebook, looking only at the numbers. I want you to say out loud, everybody's going to do it simultaneously, say out loud what happened. You're going to convert words, numbers into words. You're going to convert numbers into words. Just say it out loud. 1, 2, 3, go.
We need a $50,000 sale, $31,000 in cash, $19,000 in accounts receivable.
Looks to me like what we did is cash went up by 31, AR went up by 19, earnings went up by 50. Looks to me like what happened is we had 50,000 in sales, of which we collected 31,000 in cash, and our customers now owe us an IOUs, accounts receivable, $19,000. You just converted numbers into words, which took Warren Buffett 12 years to learn how to do, and you guys did it in less than 45 minutes. O, I's, and F's. Here's a statement of cash flow you get from the accountant. And the statement of cash flow says that operating cash is negative 2,800. Negative 2,800. Now wait a minute. How much were the profits? Hello? 17,200 of profits. In theory, we had 17,200 of profits, and when we look at our bank account and where the cash came from, the operating cash is negative 2,800. 17,000 of profits, negative 2,800 in cash. Here's what this means. As business owners, we busted our ass all year long. We created sales, we bought equipment, we had payroll, we had all these expenses, we borrowed some money, we bought some property, plant, and equipment, we bought some lemons, we made lemonade, we had 50,000 of sales, and at the end of the year, our bank account is 2,800 less than the beginning of the year. In other words, had we just stayed home and not gone to work, our bank account could have been 2,800 higher. But no, we had to go to work. In theory, we have 17,200 of profits. In reality, our operating cash flow is negative 2,800. Investing cash, negative 4,500. Financing cash, plus 9,000. The only reason this business is still in business is because somebody's really good at raising money. The business is not producing enough cash to support itself. And so in order to stay alive, they have to go raise money. But they think they're doing okay. In fact, what most people would do is read a fucking book about how you can systematize your business, and when you get back, leave for 90 days, and when you get back, the business will be better than when you left it. Have you heard about this theory? Hello? That is about the stupidest fucking thing I've ever heard in my whole life. It doesn't work that way. It doesn't work that way. This business looks like it's fit because it has revenues of 50 and profits of 17. The truth of the matter is This business has a major tumor. A major tumor. And growing the business does not increase the amount of cash. Watch this. The cash flow summary of this business is we have beginning cash is 0, then we had O, I, and F cash, and so the cash flow of this business was $1,700. We started with 0, we had $1,700 of cash flow, so ending cash is $1,700. That makes sense. Problem is, when I really look and see what's going on, this business has a problem right here. This is a major tumor. So let's go back to the Rosetta Stone, and we'll go back to the Rosetta Stone in a second. The ultimate blueprint of a business is that I want to take assets and convert those assets into revenues. That's the only reason they have assets, is to convert them into revenues. The only reason I want revenues is so I can get some profits. The only reason I want some profits is so that I can get some operating cash flow. And in this business, I had $28,700 of assets that I used to produce $50,000 of revenue. I converted that $50,000 of revenue into $17,200 of theoretical profits, and I promptly turned that $17,200 of theoretical profits into a real live cash out of the bank loss of $2,800. Something's wrong. If this business stays in this condition, it will die, because there's a limit to how much money a business can borrow. Let's see where the problems are. The very first O cash, look at the right-hand screen. The very first O cash is on line 4.1. That's the very first O. And I look at that one and I say, well, $15,000 of cash, $15,000 of inventory, and then I look how much inventory I ended the year with, and I ended the year with $5,000 of inventory. Looks to me like if I could have bought $5,000 less of inventory, I could have spent $5,000 less of my cash. Hello? Yeah. And I can see that instantly by looking at the Rosetta Stone, by looking at the balance sheet. This is the balance sheet. By looking at the balance sheet, I can connect the dots. I say, okay, my operating cash is in serious trouble. One of the reasons my operating cash is in trouble is because of this line right here, where I bought $15,000 of inventory instead of only 10, because the amount I ended with 10, it was 10, so if I could have only bought 10, I could have had $5,000 more of cash. Hello? All right, so watch this. Watch this. We're going to make a little cheat sheet. We're going to make a little cheat sheet. What you and I both know, go back up here real quick. What you and I both know by looking at this page is that when inventory goes up, that's bad for cash. It's bad for cash when inventory goes up. So if during a month, a quarter, or a year, it's why I got to have multiple balance sheets. I got to be able to see the trend of what's going on with your inventory. If you have inventory, not all businesses do, but if you have inventory, I got to be able to see, well, if at the beginning of the year they started with 0 and at the end of the year they ended with 5,000, looks to me like their operating cash could have been 5,000 higher had they just bought less inventory. If they just would have bought the amount they needed instead of having some extra on hand. So when inventory goes up, that's bad for cash. Let's take a look at the second O. The second O. The second O is right here. I got $31,000 of cash, $19,000 of accounts receivable, and $50,000 of earnings, of sales. If I could have, during this year, right here, if my accounts receivable were only $9,000, listen, I had $50,000 of revenue. If my accounts receivable had only been $9,000 instead of $19,000, then the amount of cash I would have collected would have been $41,000 versus $31,000. Hello? Are you with me on this? Okay, so what this means is, since I ended the year with 19,000 of accounts receivable, my operating cash flow is suffering because my AR, my accounts receivable, is maybe too high. And so I need to become, as a business owner, really intentional about how I go about collecting my AR. And if I could figure out how to make this number right here, 10,000 less, on the exact same amount of revenue, I could wind up with 10,000 more of cash. So we're going to add to our rules. We're going to make a little cheat sheet. And the cheat sheet is going to say, when it comes to accounts receivable, when accounts receivable go up, that's bad for cash. So I can see that right here on the Rosetta Stone. It's telling me, okay, Keith, here's kind of how we connect the dots. Now, if you get good enough, you can do this with the 3 separate dials that the accountants give you. But what I'm trying to do is I'm trying to figure out, how do I get a shortcut? How do I get the optics I need without getting a degree in accounting? And that's what the Rosetta Stone is designed to do. So I've got 2 items so far that whacked our operating cash. 2 items. Inventory is $5,000 too much. Now keep in mind, my cash flow problem is only $2,800. So had I bought the right amount of inventory, that would have solved that problem. Hello? Yes. AR is $19,000. My God, if I could just cut that in half, instead of having to borrow money, I could self-fund. At the end of the day, what I want is a business that can produce enough cash so that it feeds itself and doesn't cause me to rely on the generosity of strangers. Generosity of strangers is your bankers. I don't want to have to rely on their generosity. Holy cow, every one of my bankers wants to loan me an umbrella when the sun is shining. And every time it gets a little cloudy, they start asking for their umbrellas back. And if it starts to rain, they demand their umbrella back. You big dummy, the reason I want the umbrella is for the rain, not the sunshine. Who knows what I'm talking about? So let's build a business that's sustainable, that doesn't rely on the generosity of those knuckleheads. Take a look at the next O. Right here. Here's an O right here. So I've got 3 O's on the Rosetta Stone. This one is all about inventory. This first O on line 4.1. Line 4.2, it's all about accounts receivable. Let's look at this O right here. This O is my cash went down by $16,500. My accounts payable went up by $2,000, but the total expenses were $18,500. So it looks to me like, in this transaction, that if I had a cash problem, and you're doing this in your business, by the way, everybody's doing this. So you know this instinctively. I'm just going to teach you what's happening. When you get into cash problems and you don't have enough cash to pay all your bills, your accounts payable goes up because you're conserving cash. So in this instance, if we're negative $2,800 in operating cash flow, if what we would have done is paid $5,000 less right here. So I still had $18,500 of expenses, but if this number was $5,000 less, this number right here would have to be $5,000 more. Hello? Accounts payable, when they go up, that's good for cash. Accounts payable go up, that means I get to keep the cash and don't have to pay my bills. Now I got to pay them someday. I just don't have to pay them today. So we're going to add to our rules. This is the 3rd rule that you're going to keep in mind. This one's all about accounts payable. Accounts payable. When accounts payable go up, that's good for cash. That's good for cash. When accounts payable go down, that's bad for cash. If your accounts payable from the beginning of the year to the end of the year go down, rest assured that's bad for cash. If your AR from the beginning of the end of the year goes up, that's bad for cash. If your AR from the beginning of the year to the end of the year goes down, that's good for cash. Hello? You don't have to memorize this. Just write down my 3 rules. Just write them down, and then you're good. You have a Rosetta Stone. The Rosetta Stone is designed to help you with optics. It's designed to help you understand that there is a relationship between balance sheets, income statements, and statements of cash flow. I knew for years that the 3 dials that I get from accountants are connected. I knew that. And so the amount of brain damage I incurred in order to create this Rosetta Stone is breathtaking. I knew it could be done. Thank you. If you have to learn the language of business by becoming an accountant, the deck is stacked against you. I don't want to become an accountant. I don't want to know debits and credits. I need to know the language so that I got the foundation, so that I have the platform, have the optics to be able to look. Your accountants are not going to be able to produce this piece of paper. All right, we have software that'll do it for you, but chances are your accountants will never do this. You're going to continue to get 3 different pieces of paper. And at the end of the day, it's not about those 3 pieces of paper. It's about what optics can I get. Assets into sales, sales into profits, profits into operating cash. The ultimate blueprint is assets into sales, sales into profits, profits into operating cash. Assets are stuff that's on your balance sheet. Assets that are on your balance sheet. So we ought to be measuring how effectively we're converting assets on our balance sheet into revenue. It might be you have an asset-light business. There's all kinds of businesses that don't have a lot of assets on their balance sheet. Instead, what they got is employees. So we ought to be measuring as business owners how effectively we're converting the number of employees on our payroll into revenue. That's a critical metric. It could be that say you might have a bunch of part-time or subcontract people, that piecework kind of stuff. Good. Why don't we be measuring the amount of payroll dollars you're spending, and how many payroll dollars does it take to produce $1 worth of revenue, $1 worth of sales? How many employees does it take to produce $1 worth of sales? How many dollars on the balance sheet, assets, does it take to produce $1 worth of sales? Because at the end of the day, that's why we got them. The reason we got assets is to produce revenue. Now let me give you a key distinction. A key distinction is if you pimp your ride, you spent too much money on assets, and therefore it's going to make it harder to be effective at producing sales. Watch this. Watch this. Are y'all learning? Yeah. Watch this. Suppose
I learned all this stuff right here. I wish right here is.
I have business A and I have business B. Business A requires $10 million worth of assets in order to produce $5 million worth of sales, in order to produce $1 million worth of profits. Suppose I have business B. Business B requires $100 of assets to produce $5 million of sales, to produce $1 million worth of profits. Now watch my head. Is there anybody in this room who thinks that business A is preferable to business B? Look at my head. Look at my head. All right, so there's nobody in here who's sitting there going, oh yeah, given a choice, I'd rather own business A over business B. Anybody thinking they want to have business A? No. All right, good. There's one guy in the back who is a banker. That guy in the back who's a banker, I understand. He wants you to have business A. Bankers hate it when you have business B. Bankers love business A's because they have a lot of collateral to give them security so that they feel comfortable loaning you more money. As business owners, we know what we want to do is minimize the number of assets. So now I'm going to help my banker friend at the back. Suppose I say we're going to define assets not as dollars on the balance sheet. We're going to define assets as number of employees. And business A requires 1,000 employees, and business B requires 20 employees. Is there anybody in this room who's sitting around saying, look, I can make $5 million in revenue and $1 million in profit either way. I think what I want is 1,000 employees. Anybody sitting around thinking that? No, even my banker didn't put his hand up on that one. What we want to do, listen, what we want to do is we want to minimize the assets that it takes to produce a dollar's worth of revenue. So watch this. Assets are there to produce revenue, and revenue and sales is there to produce profits, and the difference between sales and profits is expenses. So in other words, my ability to generate profits is dictated by my ability to be efficient with my revenue. How efficiently can I convert revenue into profits? Write that down. Write that down. How efficiently do I convert revenue into profits? Because at the end of the day, the whole reason to have revenue is to get it into profits. The whole reason to have profits, watch this, the whole reason to have profits is to get it into operating cash flow. And the difference between, here it comes, the difference between profits and cash flow is four things. There's four levers in your business's cockpit that if you know these levers and work these levers, you have the ability to convert profits into cash flow more productively. And the four levers are the differences between profits and cash flow, depreciation. So depreciation is an expense for purposes of profit, but it's not cash. So one of the differences between profits and cash flow is depreciation. And the other three differences are on the balance sheet. Accounts receivable, accounts payable, and inventory. So these are the four things that make the difference between profits and cash flow. The difference between sales and profits is expenses. The difference between profits and cash flow is depreciation, AR, AP, and inventory. Take a picture of this slide. This is a big girl slide, big boy slide. You want to make sure you capture this one. got Steven Spielberg. Go ahead and snap that thing. 1, 2, 3, boom. Adam, good. What? Come on. Come on, here we go. That's a, you have to have gotten that picture. Here's what I'm talking about. Assets into sales, sales into earnings, profits, profits into operating cash. Now that one, take a picture of. I gotta have all three dials. I gotta have a balance sheet to see how I'm doing on my assets. I gotta have a balance sheet to see how I'm doing on accounts receivable, accounts payable, and inventory. I gotta have a balance sheet to see what's going on with the amount of money I owe. But for purposes of the ultimate blueprint, I want things and stuff converted into sales, sales into profits, profits into operating cash. I know what you're thinking. You're thinking, Keith, that little lemonade thing was a little, example you created to trick us, right? But that doesn't happen in the real world. So good, let's talk about the real world here for a second. This is a real world company. In 1999, this real company had net income of $893 million. In 2000, it had net income of $979 million. And in Q1, the first 3 months of 2001, their net income was $405 million. First 6 months, $829 million. For the first 6 months of the year, they're at about 90% of where they were the entire previous year, and they're within 95% of where they were the year before for the whole year. This is 12 months. This is 6 months. These dudes are on fire. This is their earnings per share. So you take the number of shares outstanding and divide that into the amount of profits. And so here's the number, earnings per share, 94 cents in this 6 months. Here's their ending cash. So in 1999, at the end of the year, they had $288 million in cash. At the end of 2000, they had $1.3 billion. At the end of Q1, they had $1.1 billion. Here they got $850 million. So their cash is going down. But look at this. In 2001, June of 2001, they still got $850 million in cash, which is 3 times the amount of cash that they had 18 months earlier. So these guys are in good shape. They're tearing it up on their earnings. They're tearing it up on their earnings per share. They're tearing it up on their cash. And the stock is publicly traded, and the stock is $61 a share. $61 a share. So do we like this thing? Well, when we don't know what to do, a lot of times we listen to our consultants, who, by the way, are not experts. Consultants have a recipe. Experts have a cookbook. Mastery is about the cookbook. And so we go to our little consultants called brokers on Wall Street, and we say, well, what should we do? Should we buy this thing? I mean, my God, they're lighting it up, right? So we listen to Lehman Brothers on March 12, 2001. The stock is at $61.27 a share. And Lehman Brothers says, this baby looks good. Strong buy. Merrill Lynch on March 21st said $55 a share. We think it looks good in the near term. You should buy it. Goldman Sachs at $55.31 a share on March 29th said, we recommend this thing. It's good looking. You should buy it. Attractive said the smartest people on the planet at Bear Stearns at $51 a share on June 8th, 2001. Watch the dates, watch the price. June 15th, 47 a share. Buy it, said J.P. Morgan. Accumulate it, said A.G. Edwards. Strong buy, said Bank of America. We recommend it, said Goldman. Attractive. This thing is good looking, said Bear Stearns at $40 a share. $30 a share, Saunders Norris has to get in, and they think this thing is good looking, so they want you to buy it. We recommend it, said Goldman Sachs. Now, they recommended it back at 55. Here it is down to 33. So they're going to tell you, if you liked it at 55, you're going to love it at 33. Right? We recommended it at 55. Holy cow, Wall Street's having a sale. Go ahead and buy it. So here we are at 33 bucks a share on October 3rd, 2001, and the smartest guys on the planet are Goldman Sachs saying again they recommend it. Buy it, said A.G. Edwards. Strong buy, said First Albany. Long-term buy, said Merrill Lynch. Buy it, said CIBC on October 22nd, 2001 at $20 a share. Long-term buy, said, yeah, now this thing sucks in the short term, right? But long term, you're going to be happy you own this. Strong buy, said the smartest guys at Lehman. The stock is attractively priced at $16.41 a share. No shit. 10 months ago, it was at 61. Buy it, said First Albany. Market perform. Market perform. You know, B of A. You know what market perform means? Market perform means I don't have a clue. I don't know. If the market goes up, I think this is going to go up with it. If the market goes down, this is going to go down. I don't know what this thing's going to do. Buy it, said Smith Barney, at 16 bucks a share. Neutral. Neutral, said Merrill Lynch. You know what neutral means? Neutral means, okay, if you already own this, you're fucked. Whatever you do, don't sell it now. I mean, look, it's down to 12 bucks a share. You've already lost 50 bucks a share. Don't sell it now. And if you don't already own it, get on your hands and knees and praise God. Right? Because we don't think you should do anything different than what you're doing. If you already own it, stay with it. If you don't own it, don't buy it. But CIBC, smartest guys over there at 12 bucks a share, said, yep, you better own it. Hold on, said Prudential. Hold on, 9 bucks a share. Hold on means, okay, it's always darkest before the dawn. It looks bad. It looks bad, but now is not the time to fold. A miracle could happen. This thing could come back. You've already lost 80% of your capital. Go ahead and hold on. You only got another 20% to go. It might come back. Let's just see. Maintain your position. That's another way of saying hold on. Market perform, said Goldman. Hold on, said CIBC. Hold on, said UBS Warburg. Hold on, said Credit Suisse at 36 cents a share, ladies and gentlemen. 36 cents a share, and the knuckleheads at Credit Suisse are saying, hold on, because the only thing you could lose is another 36 cents. We've already killed you. You've lost 98% of your capital, for crying out loud. Don't sell it now and pocket the 36 cents. Enron's numbers. These were Enron numbers. Those were the recommendations by Wall Street in real time as that thing was unfolding. You and I both know that profit is a theory and cash is a fact. You and I both know that in order to have optics, I got to have 3 pieces of paper. 3 dials in my cockpit. I got to have a balance sheet, I got to have an income statement, I got to have a statement of cash flow. I got to be able to understand how effectively, listen to my words, I got to be able to understand how effectively I'm converting assets into revenue, how efficiently I'm converting revenue into profits, and how productively I'm converting profits into operating cash. Operating cash is the big one. Profits is big, but I can't spend my profits. I can only spend cash. All publicly held companies every 90 days has to publish a report to shareholders. And in that report to shareholders, there are always 3 pieces of paper. Never 2, never 1, always 3. 3 pieces of paper in every 90 days. Apple does it, Google does it, IBM does it, Facebook does it, everybody does it. 3 pieces of paper every 90 days. A lot of things can change, but it's always these 3 pieces of paper. A balance sheet, an income statement, and a statement of cash flow. Always. There are no exceptions to this rule. Enron showed anybody who was willing to look all 3 pieces of paper. And unfortunately, what Wall Street did and what a lot of us do in our businesses is we only look at one. We get to looking at the income statement. We're all obsessed about how big it is or how much the profits are, and we fail to really get the optics to understand what's going on beneath the covers. What's the blood test on this thing? Is this thing fit or is it healthy? And I got to be able to have the blood test to be able to have those optics. Had anybody bothered to look, here's what the statement of cash flow looked like. So you saw these numbers previously. Here's the profits of Enron in 1999, 2000, Q1 of 2001, Q2 of 2001. This is what they told everybody. I'm about to unwrap O, I, and F. I'm going to show you O cash first. So if anybody would have looked at Enron's financial statements back in this time period, this is exactly what they would have seen. If you see a positive number for O cash, that means Enron generated that much cash. If you see a red or negative number, that means Enron lost that amount of cash. Let's see how Enron was doing had anybody bothered to look. I'm going to work off of this screen right here, the one in the front right. All right, here comes O cash. This is the profits. This is the theory. Here's the fact. All right, so let's just see what happened. In 1999, Enron had a theoretical profit of $893 million, and they converted that into $1,228,000,000 of cash. In 2000, they had $979 million of theoretical profits, and they converted that into $4.8 billion of cash. A++. How'd they do it? How'd they do it? There's only 3 levers on the balance sheet. How did they do it? They increased accounts payable. They reduced accounts receivable. They reduced inventory. If you reduce inventory, that's good for cash. If you reduce accounts receivable, that's good for cash. If you increase accounts payable, that's good for cash. Somebody back there is the Wizard of Oz throwing all these levers, jacking up the cash flow. That's how they were able to go from $979 million of theoretical profits into $4.8 billion of operating cash. Somebody's behind the curtain throwing levers to make this happen. Look at what happened in Q1. This is when the stock was at 61 a share. Right here, 61 a share. All of a sudden, they went from these kind of results, and in 90 days later, they told the world we have $405 million of theoretical profits, and we converted that into a real live cash out of the bank. Cash out of the bank loss of $462 million. Had Enron just told all their employees, stay home for the next 90 days. Don't come to work. They could have had $462,000 more of cash. No, they had to come to work. That's what happened. And then the next quarter goes by, and all of a sudden they got $829 million of theoretical profits, and they lost $1.3 billion in operating cash. This thing looks awesome. But if you do a blood test, it's got big time problems. And the smart people on Wall Street saw the problems. The people who weren't so smart didn't see the problems. And the people who weren't so smart are the people who didn't have optics. Better optics equals better decisions. Better decisions equals more money. How do I get optics so that I don't wind up doing something stupid? This is O cash. There's two other kinds of cash. I cash is next. So if you see a black number, that was good for cash. That means they sold a bunch of their shit. If you see a red number, that means they went out and they bought a bunch of shit on their balance sheet. That's what they did. All right, let's take a look. Here it comes. I cash. In 1999, they went out and bought a bunch of shit right here. 3.5 billion. That was bad for cash. Then they turned around the next year and sold a bunch of their shit. And then they sold some more, and then they bought some. All right, so this is all going on in the background, right? They're buying and selling assets as part of growing or reducing their business. Here comes F cash. If you see a black number, that means they borrowed money. If you see a red number, that means that they repaid money. If you see a black number, that means they borrowed money. Borrowed 2.5 billion, borrowed 600 million, borrowed $1.3 billion, borrowed almost $2 billion. The only reason Enron was able to stay in business is because somebody's really good at telling the story and raising money. They did really good with their cash right here in this first time period. And then all of a sudden, in the next 6 months, they just went off the rails. And the people who couldn't see it got trapped. I love this article that happened in an Oregon newspaper back in 2001. The article says this: as 2001 started, Tim Ramsey felt like $1 million. A 55-year-old electrical worker, Ramsey was ready to take early retirement after 33 years with Portland General Electric. His retirement nest egg, fed by more than 30 years of steady savings, had grown into a golden goose worth more than $1.25 million. As 2001 ended, the golden goose was almost a goose egg, having collapsed to less than 10,000, and Ramsey's retirement plans are nothing more than wishful thinking. I was a big sucker, Mr. Ramsey recently mused. For some reason, I don't know why, I listen to those people. I should have my butt kicked. And he did. And he did. See, he forgot. He made the classic mistake of thinking that the key is to get rich. The key is not to get rich. The key is to get rich and then stay that way. And in order to stay that way, you have to have business skills and tools. You and I have seen it 1,000 times. If you and I tried to add up all the times we have seen somebody going out of business, and the reason they're going out of business is because what you can't see can kill you. You know that, and I know that. It's why we go to the doc. It's why when we go to the doc, they just don't look at us to tell us how we're doing. They do the blood tests. They want to see what's going on behind the scenes. Let me look under the covers. Let me see if I can spot something that, if it's not tended to, could actually turn into a crisis, into a catastrophe. And more often than not, the problems that we have, the crises that we have, are a result of untended to problems. A problem happens, we don't tend to it, and now all of a sudden it gets infected and it turns into a crisis. You've seen this sign just like I have. You've seen this sign 1,000 times. What do you think's going on with this business? Do you think the reason this business is hanging that sign out is because the owner and the founder had a lack of passion? Is that the problem? Oh, God, they're going broke because the owner just wasn't passionate enough. I guarantee you he's lost his passion now. But when he started it, this dude was, whoever it is, was very excited, very emotional. Is this dude going out of business because it's a bad idea? Probably not. You can name me any product or service. I don't care what it is. Any product or service. It could be shoelaces, it could be chewing gum, it could be seminars, it could be clickers, it could be shoes, it could be cheeseburgers. Name me any product or service. Give me a week and I'll name at least one person who's made millions and at least 100 people who've gone broke with the exact same idea. It's not the idea. Write this down. This will be the most important thing I say. Write this down. Your success has very little to do with what you do and everything to do with how you do it. It's not the what you do, it's the how you do it. You don't even have to have a very good product and you can make a ton of money. If I ask you, how much time do I have left? Back in the back of the room, somebody just type it up here. I've lost total track of time, sorry. Okay, good, thank you. All right, so I have about 60 seconds. If I ask you to think about your favorite restaurant, I mean the one if you were going to go celebrate, this is the one you go to. Everybody in here's got a favorite restaurant. There isn't a single person in this room that's thinking about McDonald's. And yet, nobody's made more money in the history of mankind in the restaurant business than McDonald's. It must be because their cheeseburgers are so tasty. Right? No. Their cheeseburgers taste like shit. Their French fries, on the other hand. But the cheeseburgers, my God, they're horrible. Not only are their cheeseburgers horrible, but if you eat enough of them, it'll kill you. So here's the most successful restaurant in the history of mankind that truly makes the crappiest food you can find. And if their customers eat enough of it, they'll have no customers because all their customers will be dead. It's never what you do. It's how you do it. Holy cow, look at Apple. All my technology expert friends, the geeks, they all tell me, Keith, Apple's operating system is better than Microsoft's. I don't know. I don't have a dog in this fight. I happen to have learned on Microsoft, and it's what I know how to do. I tried to make the transition over to Apple. I couldn't incur that much brain damage. I didn't know how to do it. I got lost. I said, no, never mind. I'll be uncool. I'll be one of the uncool people that uses Microsoft. But all my friends tell me Apple's better. So now check this out. Apple's a better system than Microsoft, and Steve Jobs got there before Bill Gates. The guy who got there first with the better product has 10% market share on operating systems, and the guy who got there second with an inferior product has 90% market share in computers. It's never what you do. It's how you do it. Everybody's wound up about what they're supposed to do. Shoot, let's figure out how to do what we're supposed to do. There's a guy that's going broke because he read a book about here's how you get rich. Knock out 4 hours a week. Is that why this guy's broke? Because he's decided to work the 4-hour work week? Which is probably one of the most intergalactically stupid concepts I've ever heard of in my whole life. Seriously? Seriously? We're gonna knock out 4 hours a week and get rich? Name me one person on the Forbes 400 that got there by knocking out 4 hours a week. Name me one person on the Forbes 400 that's staying there by knocking out 4 hours a week. A 4-hour work week is a great idea if your competition is only knocking out 2. But if your competition is knocking out 60, 70, 80 hours a week and you think you're going to win the gold medal by somehow showing up and doing 4, you've lost your fucking mind. That's a fact. Besides that, why do you need a 5-hour energy drink if you're only going to work 4? Holy shit. Now, let me tell you why this guy's going out of business. This guy right here is going out of business because he didn't have optics. He thought the key was to get big. He thought the key was to pour fertilizer on a search engine optimization social media strategy. This guy thought the key was somehow to increase the top line. And I'm not saying those are bad ideas. I'm just saying if you got a tumor, gaining 50 pounds doesn't help. This guy had a tumor and he couldn't see it, and the reason he's going out of business is not because of a lack of revenue, it's because of a lack of cash. He cannot pay his bills. And that's why he's going out of business. And it happens all the time. And it happens because people don't have optics. They don't have a treasure map with a red X that says, dig here, man. This is where you're supposed to dig. And the reason you want to dig here is so that you can plug your profit drains and maximize your cash flow and increase your returns and anticipate crisis and spot danger signals and optimize performance and drive results and maximize the enterprise value. How do we maximize the enterprise value? How do we make sure that what we're creating is sustainable? How do we increase the predictability and the sustainability of the future stream of earnings? And that's what business mastery is. Business mastery is understanding, here are the levers that I need to throw in order to drive performance. And there's not a way for me to become a better operator. Instead, what I need is owner skills and tools. I need that owner hat. I need the hat that gives me the ability to run my business as opposed to operate my business. I need optics. And what accountants do all day long is accountants convert activities into numbers. And what we want is some sort of scoreboard or scorecard that will convert the numbers back into activities. And most of us don't know how to do it, but there's a way to do it. There's some software that I've created. Rita, this is where I need some help. I'm not sure where Rita is. This is where I need some help. Thank you. So look, what I'm looking for is a resource that will allow me to convert. Yep, go ahead. We're ready. Thank you. So make the camera come to me. She's gonna fix something. About 5 or 6 years ago, I was with a group of business owners, entrepreneurs in one of I think it was the 4-day MBA that I teach. And somebody brought me their financial statements and they said, Keith, could you just have a quick look at this and tell me what you see? And so I looked at it, and I'm pretty good at this, and so I told them what I saw. It took me about 5 minutes of looking, and I said, okay, look, here's the 5 or 6 things you ought to pay attention to if you really want to fix the fundamentals of your business. And somebody overheard that, and they brought me their financial statements and said, can you look at mine too? And so I looked at theirs in 5 minutes, and then I gave them 5 or 6 things that are fundamental, how to really put money in their hip pocket and do a better job running their business. And pretty soon there was a line down the block of people that wanted me to look at their financials. And I said, all right, look, here's the problem. There's only one of me. And there's a lot of you. And so what I need to do is create a tool. If I just had a tool, I could teach you how to do what I do. But what's missing is the tool. What's missing is this little tic-tac-toe board. Hello? Remember that little thing where we did the renumbering and I just did this little tic-tac-toe board and then from then on you got it? Well, what's missing is that tool. And so I got busy. I didn't know I was doing it, but I got busy and I had more money than I did since, and I started hiring software developers. And I wound up creating a piece of software that's called CFO School Board. I showed it to Tony Robbins about 4 years ago for the first time. It was still in beta and it had a few glitches and some rough edges, but I was in Fiji with him teaching at his resort, and this thing was just getting done, and Tony looked at it and went, oh my God, this does it. This is the thing that allows people to get optics. So here's what we do. We take your balance sheets and income statements and we do all the behind the scenes work, and then we present you the information and the opportunities so that you don't have to become an expert at all the calculations. You don't have to really try to become an expert at accounting. You know the fundamentals at this point. And what I want to be able to do is take maybe 7 minutes of your time and do a very, very high level show and tell. I'm going to do a quick demo of this. Whoa. And at the end, I'm going to give you an opportunity. If you decide this is something that would work for you, I'll tell you about it, and I'm going to give you an opportunity to add this software to your tool belt. At the end of the day, the software is available. I'm not going to try to convince you to buy it. I don't try to convince people to come and study with me or buy my products, buy my books, buy my DVDs. If I try to convince you, then I care more about your dreams than you do. I think that's a prescription for disaster. Here's what I want to do. I want to present it to you, let you take a quick look. It ain't going to be a deep dive. It's going to be a quick look, and you're going to instantly be able to see, yep, that's something that will support me in making more money in my business and having optics, or no, I don't need it. I'm good either way. I'm good either way. This is for you. And so I'm about to change how I'm interfacing with you. For the last 4 hours, 2 hours today, 2 hours yesterday, all of my teaching with you, I've been like this, where I'm connected to you. And I'm about to disappear up here behind this machine, and you're going to be looking at a screen, and I want to make sure that you don't bail out on me. So I'm asking your permission to let me just push pause in how we're doing this. I think you've gotten value from this. Thank you. And I'm asking you to trust me. I think you'll get value from this too. So this is not a break. This is not a time to start squirming around. I'm almost done, and then you can go have your break. Give me about another 10 minutes. I'll show you this tool, and we'll put a bow on this thing. Is that good? Yeah. Okay. This is a balance sheet. On this balance sheet, you can see that I'm trying to find something to move my mouse. That ain't gonna work. Okay, good. Here's the balance sheet, there's assets, and I can see there's, liabilities down here. And if I wanted to, this is from QuickBooks, this is from Xero, this is from whatever accounting system you're using. There's one column of balance sheets, and I could analyze that probably without a bunch of software, but when I start adding balance sheets and start adding multiple time periods, this thing gets a little more complex. And keep in mind, what I'm looking for is trends and relationships. And there's a lot of math that can happen when I start having multiple trends and time periods. And so that's a balance sheet. And then if I look at a profit and loss and income statement, I got the same problem. Here's revenue up here, and here's cost of goods sold right here, and here's gross profit. And I can do those calculations for one time period, but my God, I start adding multiple time periods, trying to do all this math, and this thing is going to get very, very complex in a hurry. Furthermore, I'm not sure when I got all done I'd actually have optics. So watch this. Suppose I gave you a tool in which you give me all your income statements. You just give me all your income statements. You give me all your balance sheets directly from QuickBooks, whatever you're using, whatever software you're using, I don't care. We don't replace your software. We give you optics. You're going to keep doing all your accounting. Suppose you gave me balance sheets and income statements, and we uploaded it. You don't have to retype it. We upload it into CFO School Board. If you give me this, I will give you this. At the end of the day, I want optics. This is your business, and I'm going to show you very, very briefly how this works. Right now, I happen to be in the month of September 2017. You update it every month. If I wanted to, I could see year to date. I can see year to date by clicking on this. All these numbers right here will change. Watch this. Here comes year to date. Every one of those numbers changed. Here comes trailing 12 months. I can see trailing 12 months. I can see with a click of my mouse what happened in July of last year. So it's going to tell me this is exactly what happened. This is real time. So I'm going to go back to year to date. Here's what happened year to date. Revenue year to date, so it's going to be 9 months, 4.7 million. I'm in the revenue, and this is monthly revenue. So when I mouse over this, it tells me what the revenue was. And right now I'm looking at monthly. I could look at trailing 3 months. This is the 3 months ending in September, 3 months ending in August, 3 months ending in July. Here's 3 months of September last year. So last year, 3 months ending in September, I was $1.2 million in revenue, and this year I'm at $1.7 million in revenue. So it looks like my business is growing. This is monthly. This is trailing 3 months. Here's trailing 12 months. So I look at trailing 12 months and I go, my God, my business is doing really, really good. And then I come over here and I click on profit margin. And I see that my profits I'm actually losing money. I'm losing money, but that's after I soak the business for all of my personal shit. So all my personal expenses are above the line, meaning that these are the numbers I'm going to show the government that I lost $139,000. Now the reason the business lost $139,000 is because I got trips to Australia, I got my platinum partnership, I got let me see how my business is doing before all that shit, right? So I can click right here and I can move all my personal yaya. Now watch what happens to this number. I'm going to tell the government I lost $139,000, but in reality I made $180,000. I'm making money before my personal yaya. And I want to be able to have the ability to look at my numbers and say, how's my business doing before I soak it with all my personal shit? And then I can look at it after I soak it with all my personal shit and tell the government I'm going broke. Right? I'm good with that. Look, my job is not to get you to do anything different than what you're doing. I just want you to know what you're doing. I want you to have optics so you can see how my business is doing before all that stuff. So there's a little line to help you with that. And if I look at my profit margin and I got all my personal shit below the line. I'm looking at monthly, and my profitability percentage is bouncing around. And if I look at trailing 3 months, I can see right now I'm at 2.6, 2.7% profits. And shoot, back in December, I was at 14%. So something is desperately wrong with my business. And when I look at long term, it's even more acute. Here, my profits for trailing 12 months are down at 6.5%, and a year ago, my profits were at almost 10%. My revenue is going up, and my profits are going down, and so there's a problem. And then I look at cash and I say, where did this number come from right here? This 323,000. I had theoretical profits of 179, but my operating cash flow was 323. That's really, really good. How did that happen? I could go right over here on the left-hand side and say, oh, let me click on operating cash flow, and here's the whole cash flow story of how you got from 179,000 of profits down to 323,000 of operating cash flow. This is all the stuff that moved around. And if you see that, can you see it okay? Can y'all see this okay or not? Hello? Not that well? All right, let me do this. How we doing? All right, now watch this. In the event you don't know whether something's good or bad, I've given you a little thumb up or a thumb down. And I've even color-coded it for you so you don't get confused, right? And I'm basically saying, look, if you don't like what's going on, here's some bad stuff that's happening. Your inventory is going up, and that increase in inventory has cost you almost $300,000. And then I put the words in, that's bad for cash. And then over here I have a whole bunch of optics and metrics about how we're doing at converting assets into operating cash, employees into operating cash, payroll into operating cash, revenue into operating cash, profits into operating cash. And all this right now is in MBA language, and if I don't like that, I can switch it into plain English.
That's awesome.
My job is to help you get optics. So you're looking at this thing and you're going, my God, look at the amount of money I left on the table. I left $3.4 million on the table. I wonder what I can do about that. So I click money left on the table, and it's going to tell you, here's how this happened. There's only 6 levers. These are the 6 things that happen. We convert your receivables from dollars into days. So we're going to tell you how long does it take you on average to collect your money? How long on average does it take you to pay your bills? How long on average if you have inventory, how's your cost of goods doing? And how's it compare with your best ever? And if you were still at best ever, how much incremental money could you generate if you could somehow perform at the same level that you used to? I happen to believe that if you're going to benchmark, let's benchmark off of your best ever, not some hypothetical gold standard that somebody dreamed up. It's your business in your market with you in management. What's the best ever that you've done? And my question for you is, if you did it before, why can't you do it again? If you did it before, why can't you do it again? And if I don't understand what's going on in cost of goods sold, I can click this, and all of a sudden it's going to give me a little metric that shows me what's happening with my cost of goods sold. And right now, long term, trailing 12 months, I'm at 57%, and a year ago I was at 53%. So that 4% is 4% that could be on my bottom line profit if I could figure out a way to control my cost of goods sold. The idea of CFO School Board is to give you optics, not metrics. Is to give you optics. I mean, right here, I've got this whole section on dig here. Here's where you need to dig. Here are the 5, 6, 7 things that if you wanted to have the most significant impact on the economics of your business, pay attention to these, because these are the ones that have the biggest bang for the buck. These are the ones that, if for a small percentage change, you can make more difference with these than anything else. And I can click on any one of these, and it gives me little optics and metrics about how we do the calculation and how much money is being left on the table. I've got optics on cash flow, profits, revenue, return on assets. If I go to the top of the page, I've got all kind of coaching. These are all videos right here. Rita, am I hooked up to sound? Am I hooked up to sound or not? Okay, here it comes. So here's one of the videos. I've included all these videos. Here it comes.
How do I get big so I can get rich?
How do I get big so I get rich? Okay, you go. This is the only tie I own. I've yet to been able to find a tie that makes me any smarter. So, look, there's all these videos embedded in the back of this thing. They're, 5 minutes.